Hi everyone. So today we have ninth class, and like I explained in the last class, we will be looking at the remaining aspect of the final learning outcome. We've discussed about the competitive advantage and then about the further details on strategic applications, the importance of those, and so on and forth in the last class. So this class will be your theoretically it will be your final class, so I will discuss on the calculations and how to address those calculations and come up with strategies and so on and forth. Let me just take you through the slides. So most probably we'll cover incomplete today. All of your learning outcomes will be completed by today. So I'm gonna share my screen. We've covered partly on this. So today we're going to look at this section. So it's about the international investment decisions, and we're going to look at other factors such as NPV, IRR, and the calculations of those, the pros and cons, and so many things related to those elements, right? So let me just take you guys through that. Right. So this is about the international investment decisions. So I'm going to read this and explain to you guys as we normally do. The criteria which investment opportunities are selected will vary between companies. So there will be different criteria because every business would be different. So there cannot be one element that we could focus upon. So it differs from one to another. So therefore, we will be able, because if we only know the difference, we'll be able to decide on what sort of a suitable method could be applied for the organization, and then further how the investment decisions could be decided upon. And what they're trying to say here is the investment opportunities are selected will vary between companies, because one organization may tend to invest in or may tend to invest in a larger scale, whereas the other organization or the company B will tend to invest on a smaller scale. So depending on the criteria, the theories and the tools used would also differ. Okay. Many multinational companies would prefer to invest in domestic market and would be willing to enter internationally only if they could secure a high rate on capital by doing so. Right. So basically, this is something we covered in the first few lessons, I would say, right? Because we saw about multinational organization, about international transfers, and we also discussed about developed and developing countries, what sort of a relationship they have. Why would a developed country organization situated in a developed country would want to move into a developing nation? So we saw all these criteria. So that is what is applied here. So many multinational companies would prefer to invest in the domestic market and would be willing to enter internationally only if they could secure a high return. If you don't secure a high return, or if you are not going to achieve any profits, or if you are not going to expand in any terms, it would be not effective for your organization to move into an international market, because there are going to be costs incurred. So if you are not able to control those, it is not very likely, it's not effective for you to go into an international market. Rather, they can operate in their domestic markets, lower cost comparatively to the international market, I mean, and then they can make reasonable amount of profits. Okay. However, there are few reasons why multinational companies would undertake foreign investments that is uneconomic: to expand worldwide, to safeguard an existing interest. So these are the two main elements that they are talking about: to expand worldwide. One thing is to establish the brand. because they just don't want their brands to be seated in the domestic market itself. Instead, they want to expand it internationally. They want to make it globalized. They want to go in, they want their brand to be recognized by all the people. Okay. And then to safeguard its existing interests. So they want to safeguard it. They don't want it to be lost. Right. Research indicate that MNCs do not have a master plan for international investment, however, depends on the availability of the project rather than the finance available for investment, which is the key aspect of investment decisions. Although they do not have a plan, they depend on the viability of the project rather than the finance available for investments. Right? So this is the basic concept of international investment decisions. Right. The next is about the factors affecting the international investment decisions, right? The investment decisions. So first one, the status, if the investment, if it would be permanent or temporary, right? Then if it is best to operate as a branch or should a separate local company be created based on the following considerations. So they want to make sure that it can be separately operated as a branch or it should continue as a separate local company. So that depends on the following elements. Tax and laws of the country concerned, because these elements we have actually covered in the previous sessions, because we saw the reasons for the people to move to another country from their originated countries. So one of the reasons we also looked at was tax and laws. If it's flexible, they would be willing to move, right? So that is one of the elements, tax and laws of the country concerned. Strategic policy regarding decentralization of control of subsidiaries in special EU rules, European Union rules. Where borrowing is envisaged, should funds be borrowed locally, provided through the parent company, or raised through the euro markets? Exchange risk involved, cheapest and safest way of providing capital. So these are some of the elements that they would consider when trying to move out, right? So these are the factors they would consider, or these are the factors that would affect as well. Right. The political, economic, and currency environment include the including the important factors below, which would determine the stability. So first would be the stability of the market of raw materials. We also saw the raw material element in the previous sessions, because that is one of the very important elements. If you are operating as, if you are operating in a manufacturing sector, raw materials play a very important role. Without raw materials, you can't do anything. And if you are going, even if you are operating in your domestic market, and if you can't source your raw materials properly, it will be very difficult for you to manage. So that is one of the reasons why businesses move into international markets, because to stay closer to the raw materials. Controls on movement of product and currencies, particularly how different the repatriation of funds may be in future. Inflation, local taxes, again, those points are being spoken here. Political considerations, if it would be wise to have local participation in the selected country, the government support, like interest rates, lowering interest rates in order to expand investments, foreign direct investments, and so on and forth. Other aspects of a business environment, such as communication facilities, greenfield operational activities, availability of costs of suitable labor and management, industrial relations, record of the country, and the level of competition established in the region. So these are also elements that will be looked at, right? When you are making a movement or when you are making an investment decisions internationally. So all of these elements we've actually covered in the first session as well. But now do you see how we've come this far and we're still talking about this because it is really, really important. And when it comes to strategies and global businesses, global finances, global movements, all of these are main theoretical elements which cannot be changed. These will be spoken over and over again, and there will be maybe new trends coming up. However, the basics of theory will remain the same. Okay. International investment appraisal. So here we will be looking at the appraisal methods, the calculations, the formulas, the pros and cons, and etc. Investment appraisals in multinational corporations is conducted in similar manner to the assessments of the domestic projects because there cannot be major difference. So there will be similar approaches, but then the view would be different. Okay. Cost of capital, an area of concern in determining the cost of capital to be applied. However, the risk and return pattern of the project is in any way different to that of the company as a whole, then due allowance should be made by calculating a project-specific return. Since the project is overseas, it is possible that the elements used to finance will be a mixture from the two countries concerned. So the following adjustments is a must if overseas funds are utilized. One is retained earnings and then the local currency debt. Discount rate applied, exposure to increased currency and political risk may lead to the increment of the discount rate used to evaluate projects. The discount rate is adjusted for political risk, hence the cash flows would be affected by adverse political circumstances, while the currency risk may have some beneficial effects on cash flows. So do you see how the different trends, let it be internal or let it be external, which can be political exposures and stuff, how it is affecting the rate? So it is very important. So these are important not just to understand, but also to apply, so that you will be able to understand what sort of impact that it would create. Because of that understanding, the organizations will be able to make effective strategies. Let it be internal or let it be operational. Then we have project cash flows. The project should be evidently beneficial for both the host country and its currency. Further, in terms of funds remitted to its parent company, the factors affecting cash flows will be exchange rate, different tax rates, royalties and fees payable out of the income, restrictions imposed on the flow of funds from the subsidiary to parent, and the different rates of inflation. So these are some elements that would affect it. All right. So next we'll be looking at the repatriation of profits. The objectives of organizations to go internationally is to increase the group profits and transfer value through groups. These companies need to determine the level of prices to be set for goods and services. The basis on which the transfer price for goods and services are set will affect the profit share of the group and should be determined in order to maximize group profits by developing the motivation of subsidiaries and circumventing any repatriation controls imposed by the host government. Right, so this is more of a group element. So here it's about, we can have company, mother organizations, subsidiaries, and so on and forth. But here it's more about a group element, group work together, group maximization of profits, and etc. Then we have overseas taxation. Taxation can play an important part in investment decisions because taxation is basically the money gone out. Higher taxes charged, the persuasiveness would be very less. However, if the taxes charged are less, then the organizations would be persuaded to invest in that particular region or country, because they are, at the end of the day, they are going to earn more income. No much money is paid out as taxations. Therefore, it is a very important decision. So when we were discussing previously in our class sessions, one of the main concepts that the developing countries would use to attract foreign direct investments is by lowering the taxations. If they increase, they are not going to attract them because more money is being paid out. Okay. So this is about capital budgeting for capital investments. A typical capital budgeting decision involves commitment of large initial cash outlay with the benefits spread out in time. If the time to recoup the initial investment could be long, it is imperative for the firm to carefully plan its investments to attain the corporate objectives. Capital investments are irreversible and costly to get out. Capital budgeting deals with investments in real assets. So as you guys know, when you study even accounts and things like that, capital is what is the money invested, right? Sometimes it would move into a sunk cost state, sometimes it could be recovered, but it is an investment. These investments are irreversible. Okay. Project. This requires a large investments which generates cash flows for a specified period of time, at the end of which the project can be liquidated. So this is a general definition of a project. The liquidation value of asset at the end of the project life is called salvage value. The project shown by a timeline diagram is depicted below, right? So let's look at the classifications of investments. Investments can be classified on several bases like the importance of it, the size, the functional activity, the cost reducing versus revenue increasing. profit profit maintaining versus profit adding. The most suitable way is on the basis of relationship between investments. The potential relationship between investments can be plotted on a continuum as shown below. So they have explained it through this diagram. If the cash flow from one investment are affected by the decision to undertake another investment, they are said to be dependent, obviously, because it's a general term used. Because if if they operate independently, then fine. But however, when one decision is being made and another aspect is being affected, then they are dependent. So in that aspect, it will have an impact. Okay. Right, so let's look at this. Return on investment. This is essentially a single period measure. The income is computed for a specific period and then divided by the average book value assets of the same year. So these are basically the calculations. These are definitions. However, you need to be careful in understanding the calculations, the formulas, because these are something that should be calculated and applied upon. Okay, so this is the formula of ROI, and this is about the earnings before interest and tax. So you guys can take this down. Like, so like I explained below, like every aspect that you do, there's always a limitation because there's something that we cannot eliminate. When there is something good, there's something bad, obviously. So there are some limitations as well, because every calculation you use, let it be in PV, IRR, or ARR, or anything, let it be, um, there's a good side of it, but also there are certain limitations. So we will look at that element here. ROI is a function of earnings and book value of investment. However, the numerator and the denominator are affected by accounting practices. Changing the method of depreciation or inventory costing will affect earnings and ROI. So this is something why we can't compare, because the depreciation calculations would vary from one organization to another. So benchmarking is something that is difficult in this case. ROI typically understates return in early years and overstates return in later years. So in that case, the strategic decisions will be a bit affected. ROI does not consider time value of money in case of multiple year projects. So these are some of the limitations of return on investments. Let's look at the cash flow based measures. Cash flow is the net of cash inflows and outflows within a time period. Earnings, on the other hand, are the net of inflows and outflows from completed operating cycles. Cash flow measures inflows and outflows within a period, regardless of the state of the operating cycle. Payback period, one of the simplest ways of measuring if the investment is worth or not. The calculation is also quite simple. The payback period is determined by adding up the expected cash flows in successive years until the total equals investment. Example, assume that you are investing in a project and with an initial investment of 10 lakhs, or maybe in terms of pounds too. The cash flow from the project are given below. So let's look at that example. So this is how it is. So once you come up to this level, then that's okay. You have covered your period, right? So once you've investment, it takes up to 3.8 or 4 years for you to overcome that, or for you to get the return out of your investment. This is what the calculation explains, right? So as you can see here, so from this point onwards, so partly 4 because it's more than 10 lakhs, but you all like you anyway reach that level, okay? So as they comment here, the acceptable projects are which have the shortest payback period, because within a short span of time, you are able to get the return back. So shorter it is, the better it is. Right. So let's look at the limitations for the payback period. Time value of the money is ignored, and it considers the cash flow until the investment is recouped. However, ignores cash flows that occur after that. Less correlation between riskiness and payback. So they don't consider the risk elements there. Discounted cash flow methods. Discounted cash flow measures are based on cash flows and explicitly considers time value of money. The three types are net present value, internal rate of return, and discounted payback. So we will look at these separately. Net present value, sum of the present values of expected project cash flows and initial investments. So that's about the net present value. So calculation is as follows. Estimated project cash flows, choose the appropriate discount rates because usually the discount rates are given. Then you calculate your present value of project cash flows and deduct initial investments. So your assumptions are these 2 points here. Then you also have limitations like I explained previously. Since it considers all cash flows, it is biased towards longer term projects. NPV is an absolute number. One can make the mistake of rejecting a project that has a slightly lower NPV by not asking what the initial investment is. When compared to another with an NPV of 200, if the latter requires much higher investment. So these are some of the limitations of net present value. So this is internal rate of return. The internal rate of return is the discount rate at which the present value of cash flows equal the present value of cash outflows. So NPV should equal to 0. IRR is the discount rate at which NPV equals 0. Example, consider a project that requires an initial investment of 10 lakhs. The expected cash flows are shown here. Assume the appropriate discount rate is 15%. So they are also giving you the discount rate percentage here. So this is how the calculation goes for that. Okay, so you guys can take this down. So let's look at the limitations of IRR. Since IRR is a scaled measure, it is biased towards smaller projects. IRR assumes that intermediate cash flows are reinvested at IRR during the life of the project. Competition may drive down earnings in the long run to normal levels. At some instances, more than one IRR is obtained, making decisions difficult. So these are some of the limitations of IRR. Right. Right. So let's look at the strategic approach. Organizations that develop international strategies considering its overall strategy, which includes its operations in the domestic and international environment. So they need to develop international strategies considering its overall strategy, because they cannot ignore the domestic element because that is where they started. So therefore, it's important for them to expand together with that. So following are some of the facts to consider. Scope of operations, the geographic locations, countries, and the regions of possible operations, potential market niches in various niche is emphasized in this component. With the scarcity of resources and since distinguished regions offer different advantages, managers should select markets that provide the optimal opportunities, because it depends on choosing the market basically. Because you need to, you as a manager, you can maybe check yourself and that perspective and think about this. So you need to be well aware of the opportunities available in the market. If you are not going to make use of the opportunities, then it's going to be a disadvantage. So you need to make sure that you enter into a market which has the optimal use of opportunities there. And then again, resource allocation. The component focuses on the resources a company consists of and how they can use them to successfully compete in the market. Thus, determines the relative importance of various organizational functions and bases the allocation of resources on the relative importance of each function. Then we have the competitive advantage element. Competitive advantage is determining the aspects of what the company excels at and that can do something better than the competitors. Some of the techniques that can be identified as competitive advantage in a particular organization is superior technology, implementing more efficient organizational practices and distribution systems, and cultivating well-known brands. Further, this component identifies not only strategies that are existing, but also developing a potential areas to complete. Then we have synergy, which is working together. The global strategy should evolve, establishing a plan for a company that enable its various functions and operations to benefit one another. Right. So these are some of the strategical concepts and aspects that need to be considered in a business point of view or in a managerial positions point of view, because without considering these factors, it would be very difficult to move forward. Either you operate domestically or internationally. These are some of the basic elements that we've covered in the previous sessions as well. So now you see how it's connected, because overall, if you consider when it comes to global strategy and finance, there is a financial perspective. There is consideration of the domestic as well as the international context of strategies applied. So you need to be very careful in understanding that, like I've always explained in the previous sections, the connectivity is really important, because in an organization, there are different departments. However, the different departments cannot operate individually. If it starts to operate individually, you cannot, as an organization, achieve your overall objective. So there will be a problem in that sense. So it is very important that you work together, and each aspect, either it be HRM, finance, marketing, research and development, all these things have minor things inside. They will be working towards the operational element, short term, long term. We've also covered that. And about resource allocations, whether it's to be done domestically or to be moving internationally, all those elements will need to be worked together. So it's very important, either you operate in the domestic market or international market, you need to work together and develop your strategies effectively and efficiently in order to achieve profits. Okay, so this is all about this session. So we've covered everything as of now. So any questions anyone might have, you can always email us and we can check further. Also, I will make sure to maybe discuss on the assessments as well. So in a way that would help you guys to understand what the context is, and also to the way as a guidance how to write your assignments. So we will maybe cover that in the next sessions. However, I will check on that and I will get back to you. So yeah, thank you for this, and I will see you soon.